So welcome to the Wednesday Lunchtime Drive-Thru. I'm Damon King, Certified Financial Planner with Chapelwood Financial Services. This is our first drive-thru of 2025, so Happy New Year. And we're starting with a big one, the 2025 economic and market outlook. Obviously, that's going to be top of mind for everybody. What's going on with the market and the economy this year? And throughout today's presentation, if you've got any questions, you can put them in the Q&A button, and I will share those here with the rest of the group. So let's go through this. You know what? Here, I keep getting this weird message, so I'm going to stop sharing that for just a second, and then I'm going to share my screen again. My apologies. There we go. I think the weird message went away. Okay. So if you've got any questions, please put them in the Q&A down below. So let's acknowledge the obvious. 2024 was a fantastic year. If you open your account statements on the annualized basis, all of your accounts should have been up. Even if you were conservatively invested, every account you had should have been up last year, unless, of course, you had an account that moves opposite the stock market, a hedging strategy or some kind of a managed futures strategy. But anything tied to the traditional stock market should have been up. But your December statement probably had a fat negative on it, or not a fat negative, but a negative, because the S&P 500 was down 2.38% in December. So 2024, as great as it was, ended with a little bit of a whimper. And a big part of the reason for that is because the Fed signaled fewer rate decreases in 2025 than they had originally anticipated. The market expected there to be multiple rate decreases in 2025, and when it heard that, it didn't get what it wanted. So what do I tell you all the time? When the market doesn't get what it wants, it throws a temper tantrum. So there was a pullback in December. Fears of rising inflation have been reignited by the potential for new tariffs. So, of course, the Trump administration, and specifically President-elect Trump himself, wants to raise tariffs on many, many imported goods. We're going to talk about that here in just a little bit. And the fear of that sparking inflation, if the price of imports goes up, we have to spend more on those imports. If we're spending more, prices go up, inflation goes up, and if inflation goes up, then it makes it far less likely that the Federal Reserve lowers interest rates. So that was a fear at the end of 2024. The other issue is this. The growth in the market, the growth in the S&P was fantastic. It was up 25% last year. But the reality of the situation is that the vast majority of that growth, about 90% of that growth, is still tied up in about 7 companies. All right. So that growth that we saw in the market was not evenly shared across all spectrums of the market. And yes, Bill, I am recording this session. I am recording this. So I'll be sharing this for sure. So there are lots of things that were causing uncertainty, some fear that all crept back in to end 2024. So with all that in mind, what's the outlook for 2025? I'm actually going to give you an executive summary of everything, and then we're going to go through each individually. All right. So there's actually a lot of good news to share with you. I set that up, right? I gave you the depressing part. Now we're going to talk about some of the stuff that's good. There are still some concerns, but it actually looks like a pretty good outlook. So the economy remains strong. In fact, through 2024, you go back 11 straight quarters, the economy grew for 11 straight quarters. Inflation continues to slow. And even though the Fed is not planning to lower rates as often as they had expected, they're still pricing in, they're still planning about 2 rate decreases in 2025. Even if tariffs go up, the market and the economy largely believe that Trump's policies will be pro-business, low taxes, low tariffs to protect American industry. So his policies are largely looked at to be pro-business. And as a result, at this time, we and most of our investment strategists are projecting that the economy will grow by about 2.5% in 2025. To put that into perspective, normal growth of the United States economy is about 2% per year. All right, so we're looking at something on the order of about what we would expect in any given year. Year one of a presidential term is generally positive for the market. I've got a slide that I'm going to share with you here in just a moment about that. We have seen consecutive years of 20% growth. So 2023, 20 plus percent growth in the market, 2024, 20 plus percent in the market. What does that trend tell us about the third year? I have a slide that I'm going to share with you about that. Corporate earnings remain strong, so company profits are up. And most analysts see the S&P 500 ending the year somewhere around 6,700. And based on where it started, 2025, around 5,800. If we got to 6,700 by the end of the year, that would be equivalent to a 14% increase in the S&P 500. So depending upon your risk level, how exposed you are to those stocks, that would dictate your return for the year. So it looks like a pretty decent year could be on tap for the market. In 2024, the S&P 500 hit 57 new all-time highs. 57. So there are 300 and how many trading days are there? Let's say there are 350 trading days. You know, they're closed for federal holidays and things like that. Let's say there are 350 trading days in the year. About a sixth? 1/6 of all those trading days were all-time highs. And at no time, not one trading day in the entirety of 2024, did we even have a correction of 10%, meaning a drop of 10% from a high to a low. We never got minus 10. That is very strange. It's very unusual that we don't have at least one correction of 10%. 5% pullbacks happen all the time, but we did not have one correction throughout the entirety of 2024. Very unusual. In fact, it's more usual for there to be volatility throughout the year. That's the norm. And we do believe that in 2025, volatility will tick back up. And I'll share reasons why we believe that. Interest rates fell by 1% in 2024. We do expect that pace to slow in 2025. The market right now has adjusted its expectation for the number of interest rate decreases. And that's where we saw that pullback in December. Okay, the market didn't get what it wants, so now it reprices in. Okay, well, what do we think is going to happen? And right now, the market is pricing in anywhere from 1 to 2 interest rate decreases in 2025. I think that's prudent. I think that's about what we're going to see. So right now, the market is pricing in that expectation. There are still some external risks that remain that could mess all of this up. Inflation is still a possibility. It's moderating. It's still coming down, but it is still a possibility. We don't know what's going to happen with tax policy, right? The lower tax rates expire at the end of this year. I have every reason to believe that we will see an extension to the Tax Cuts and Jobs Act 2026 and beyond. But it has to happen, right? Congress has to pass the bill and the president has to sign it. So we still don't know what's going to happen. We don't really know what's going to happen with the majority of President Trump's administration, whether it's his members of cabinet or his tax policies, his trade policies. We don't know. So there's a lot of uncertainty. We still have conflict in Europe and the Middle East. So there's a lot of uncertainty that remains. But for the most part, the future for the economy and the market in 2025 look pretty good. So now let's peel this onion back and let's look at the different parts of all this. So let's first talk about the economy. And again, if you have any comments or questions about anything, please put it in the Q&A. So let's talk about the economy. So this is the trend of the economy, economic growth. And you can see here that since COVID, which was 2020, so you'll notice that in the COVID year, 2020, the economy was down 28%. Now, this is by quarter, all right? So there are 4 bars for each quarter. The first and second quarter of 2020 were terrible negatives. And the second quarter was the worst because that's when COVID really began to spread across the world and everything was shut down. But notice in the third quarter, it rebounded significantly. And then in the fourth quarter was up too. Don't forget, the market was down about 30% at one point in the year 2020. And by the end of the year, it finished near 20% up. It was almost a 50 to 60% swing. The market was positive. All right. We had positive years for the market in 20, 21, 23, and 24, and actually 2019 if you go back. So from 2018 to 2024, that's 18, 19, 20, 21, 22, 23, 24, 7 trading years in the market. There were only 2 of those years that were bad, 2018 and 2022. 5 out of 7 years, the market was up, and in some cases up big. So the demise of the market is very overblown right now. The demise of the U.S. economy is very overblown. Is it growing fast? No, 3.1% growth in 2024, but that's better than the average of 2%. And this year we're projecting around 2.5%. So the economy is growing and it is strong. Why? Because people keep spending money. People keep spending money. All right. Economic growth trends. All right. Now you'll notice anytime the gray bars on here represent recessions, and you'll notice that during recessions or preceding the recession, there's a major dip in economic growth. But we are coming out of a low point. All right. We are coming out of a low point. There's really no place else to go but up at this point. All right. So it's not like we have seen crazy economic growth and the economy is severely overheated. No, the economy is actually in a really good spot. All right. Now, here are some things to take a look at in terms of recessions. How long do recessions end or begin? And this just kind of gives you, I like to throw this in here. And a lot of these were created by, what am I trying to say? Black swan events. Okay, so major black swan events. And of course, February 2020, that was a black swan event. That was COVID as well. So the recessions typically don't last very long. Sometimes they last multiple years, but even the worst one we had, 1929 to 1933, of course, that was the Great Depression. That recession lasted, in terms of the actual economy, 4 years, even though the Great Depression and the Dust Bowl lasted for basically a decade. All right, so it took a decade to totally get out of it. But in terms of the actual recession, the worst economic recession we've ever had in our history by percentage only lasted 4 years. Okay, and that's a long time, but it only lasted 4 years. So this gives you some insight into, if we did have a recession, what's the average? Anywhere from 6 months to 4 years. Okay, that's kind of what we're looking at. Here's the other reason, and I just mentioned it a moment ago, that the economy remains strong. Because consumers have a bunch of cash sitting on hand. This is what Americans have in their money market accounts as of the end of 2024, and they've got a lot of cash. A lot of cash they're still sitting on the sidelines for potential investment or purchase of goods and services. And consumer spending drives 70% of economic growth. So long as consumers have cash to spend and they go out and spend it on goods and services, the economy will continue to grow. If the consumer stops spending, that's when we see economic contraction and potential recession. Okay. So why am I encouraged about the future of the economy? Mostly because of this. People have a bunch of cash. Credit card debt is very high right now. It is true. So a lot of Americans are spending on credit, but a lot of Americans also have cash. Let's switch gears and talk about the market. This is where I'm going to spend most of my time today, about the market. So will the trend continue? So what trend am I talking about? I'm talking about back-to-back years of 20+% performance in the S&P 500. So going back to post-World War II. So after World War II, there have been, what is that, 9 years before last year, before this 2-year thing. So there have been 10 instances of back-to-back 20+% growth in the S&P 500, including 23 and 24. So what happens in the third year? Look at the performance in year 3. If you average this out, anytime we've had back-to-back years of 20+% growth in the S&P 500, year 3, the average growth in year 3 is 13.5%. The median, meaning what's in the middle, is 18.2%. All right. But we want to look at the average, 13.5%. That tracks with the expectation for where the S&P 500 will likely end by the year 2020, by the end of 2025, which is around 14%. So if we get that, we would actually hit the average of year 3 coming off of back-to-back years of 20+% performance in the S&P 500. That's pretty encouraging. All right. Over that 3-year period, if you look at the very bottom, over that 3-year period, the total growth in the S&P 500 is 78%. Okay. So again, it's been a pretty good run the last 5 years. 2022 was nothing we don't want to remember it, right? But if you look at 5 years, who would have thought that including COVID, which has been 5 years ago, can you believe it's been 5 years since COVID was a thing? Who would have thought that in that period of time, we would have had such massive growth in the market? Also, history could be on our side here. So when the S&P 500 enters a bull market, all right, a period of expansion, the time from the bottom of the market to its peak, the average is about 4 years. Now, here are different years going back to 1932. These are different bull markets. So we are currently in a bull market. And the average length of the bull market is 4 years. Right now, the bull market's going on 2 years old. So if the average is 2 years, does that mean that from now until 2027, we could see an expansion of that? Is it possible that we could see 2 more years, 2 full calendar years of market growth? History would suggest that yes, that is a very real possibility. Okay. Here's the other thing. Corporate profits right now are very strong. They've been increasing. And when companies turn a profit, their stock prices tend to follow. And it makes sense, right? When your earnings are up and when your profits are up, your stock price tends to follow. So look at 2022. Earnings went down. Well, not surprisingly, we had a bad year in the stock market. 2023, earnings went back up significantly. Good year in the market. We haven't gotten the 2024 earnings numbers yet, but it's projected to be around $233.28 per share. This is what we're looking at, earnings per share. And we had a really good year in the market. For 2025, look where the earnings per share is projected to go. If that's a 16% increase, if that's where earnings per share goes, every reason to believe that the market is going to follow. So again, they're just projections, but these are projections based on the strength of the consumer, lowering inflation, lowering interest rates, and a pro-business administration in Washington. Okay, lots of things feeding the monster. So that's also very encouraging. Now, what is not so encouraging, and I mentioned this just a moment ago, is that this rally, this growth in the market, wonderful as it's been, is very highly concentrated in just a handful of stocks. And we really need to see that growth spread out. We need to see earnings per share spread out. Because right now, anytime NVIDIA has a bad day, the market has a bad day. Anytime Apple has a little hiccup, the market has a hiccup, okay? And so it's those big companies, NVIDIA and Apple and Microsoft and Amazon and Meta and Google or Alphabet. Anytime one of those companies has a rough day or a rough week or a rough month, it is going to severely impact the market far more than some of these other stocks that don't have nearly as much influence. We need to see that change in order to even out the up and down of the market. And the good news is that the percentage of stocks with quarterly earnings per share growth greater than 10% is on the way up. If you go back to 2023, when the market was way up, the concentration was at its worst. And so consequently, you see the lowest percentage of companies with earnings per share of greater than 10%. But now that number is ticking up, and hopefully it will continue to go up, because that means that the market rally, the growth in the market, is now going to be supported by not just 7 companies, but more, which means that we're less susceptible to one of those companies having a bad year and therefore dragging the entire market down with it. Does that make sense? So that's what we want to see. We want to see the rally expand. And then you throw in the fact that there is this interesting connection between a 4-year presidential term and the growth of the stock market. Year one, election year, let's call it, is usually a positive year. All right, that's exactly what we saw. The first presidential year, this year, is also usually positive. Most of that growth comes within the first 3 quarters of the year, and then we see a dip going into the second year or the midterm year. And the midterm year, which in this case would be 2026, historically is the worst year out of the entire 4. We actually saw that play out in the last cycle. 2022 was the midterm year, and it was by far the worst from 2020 to 2024. So, I don't know if this is going to play out again or not, but historically it's been pretty consistent. So it should follow that 2025 is going to be a decent year. Why is the midterm year the worst? I mean, I don't really know, but personally, I think it has to do with uncertainty. The market, we can't predict what the market's going to do, but we certainly can understand why the market does what it does. And for the most part, it's controlled by human emotion. And anytime we feel emotional and uncertain about the future, that's going to be reflected in the stock market. In a midterm year, what happens? The president is set, but we don't know about Congress. And Congress passes the laws. They write the bills, taxes, whatever, regulations. And it's uncertain. Not surprisingly, the market is flat to down towards around the 4th quarter of the year. Why? Because once the election is over and we know who's going to be in Congress for the next 2 years, look what happens to the market. By the end of the year, it's on its way back up, so that the 3rd year of the presidential term, 2027, is usually the best, right? So just gives you some insight into what might the next 3 years look like, all right? And then, of course, I mentioned that volatility is likely going to return. What we saw last year without one single correction of a minus 10% decline in the market, highly unusual, all right? So declines of 5% or more happen 3.4 times per year, okay? Declines of 10% or more happen about once per year. Declines of 15% or more happen about, half a time, a half percent. So we don't see the big declines that often, but declines of 10% or more, yeah, we see at least one per year. And what's encouraging about that, and why you should never try to time the market, is because they happen even when the market ends on a high note. All right, we saw several declines of 5% or more last year. And if you pulled out at that time, then you would have missed the rest of a great year. So don't panic. Don't freak out. Okay? Volatility is normal, and it's likely going to come back this year. So let's remember where we're going, where we are, and where we're going. We're thinking about the long term, especially if you're one of our clients here at Chapelwood, and if we're taking money out of your accounts, chances are we're not taking money out of the accounts that are experiencing the biggest downs. Why? Because those are your long-term buckets. Your near-term bucket, where we're taking your monthly income, that's the one that's safer and more conservative and isn't experiencing those big downs. So you can put off any fears, because that long-term money, I'm not touching it for a while, and it's got plenty of time to come back. And that's why we set up your plans the way we do. Focus on the near-term money that I'm living on. The long-term money, it's going to keep growing for me if I just remain calm. But of course, that's why you have us here, right? To help you remain calm, because I know it's hard to do. So what is the likely trend for the market? So don't think of this in terms of where is the market going to end. Look at the trend as opposed to the actual number on the side. It should be a pretty decent year, okay? We're looking at, again, probably around a 14% increase in the market, just based on current factors, current trends, that sort of thing, all right? If you have any questions about that, please put them in the Q&A here as we go along, but I am going to continue on because I've got a few more slides in our last 5 minutes here. Let's talk about tariffs and imports. So this is a short slide. So here's my thought on tariffs. I absolutely believe that there will be some tariffs. In fact, we already have tariffs. The Biden administration continued a lot of the tariffs that the Trump administration had put into place before them. It's not like we went to no tariffs at all, and now all of a sudden Trump's going to slap a bunch of new tariffs on. We have tariffs. He just wants to increase them. But here's the thing about Donald Trump, all right? I believe Donald Trump loves to rattle people's cages, and his job is, I want to get people to the negotiating table. So how do you do that? You throw out something outlandish, something completely out of the norm, freak people out, so that then they like, let's talk about this. Then you come to the negotiating table and cooler heads prevail, right? So do I believe that all those tariffs that he talked about on the campaign trail are going to happen? No, I don't. I really don't. What happens on the campaign trail tends to stay on the campaign trail. What happens in Washington when it's really time to negotiate usually is moderated, all right? So that's really what I believe. I believe it's a negotiating tactic. But even if a 60% tariff on all Chinese imports is assessed, let's put that into perspective. Everybody thinks China is our biggest trading partner. Not necessarily. So this is a chart that shows you where do our imports come from, all right? If you look, okay, China is the red line. The greenish line is imports from Europe, and the purplish line is imports from Mexico and Canada. All right. So in terms of customs basis, okay, we import far more from Mexico and Canada than we do from China. We import more from Europe than we do from China. Okay. China accounts for about 18% of our total imports. Okay. It accounts for 1% of our total gross domestic product, our total economic output. China is big, but it isn't that big. In fact, if you really want my honest opinion on it, China needs us a lot more than we need them. Do we import and buy a bunch of stuff from them? Sure we do. But even if prices went up for Chinese goods, there are other goods out there. Prices would go up, sure, but I don't know. I think that the fear of that is a little bit overblown. We'll see. But China is not as important as a lot of Americans believe it is. I think China gets the attention because they're the commies, right? They're the communists. And we've all been trained, fight the communists, okay? Back in the 80s, we feared the Soviets, and now we fear the Chinese, and to a lesser extent, North Korea. So there's a little bit of that commie baiting, right? It's politically, it's great. Let's go after the commies. But if you just boil it down to economics, absolutely, the Chinese are out there to supplant the United States as the dominant economy and currency in the world. They got a lot of work to do to get there. It isn't going to happen overnight. So just keep that in mind. Taxes and government spending. Let's talk about that. Oh, that title up there should have said something different. Okay, so I just wanted to show you this, that government spending has gone up significantly, as you can see there, all right? And generally, when taxes have gone down, the government tends to spend a little bit more, but look at that. Taxes have only gone up. Taxes are the blue line. Taxes is a percent of gross domestic product. But look what the government is spending as a percentage of gross domestic product. That's this light blue line that's really peaking there. The government is not bringing in near enough tax revenue to cover all of its spending. That's not sustainable. It's not. So will the Trump administration bring some of that government spending under control? I'm pretty sure that's one of their plans. But the only way to bring that out of balance, that balance back into line, is to raise taxes or to allow taxes to go back up. But we already know that that's not what the Trump administration wants to do. So the only way then to bring it back into balance is to cut government spending. Well, that's what Elon Musk and Vivek Ramaswamy, I always mess up his name, the Department of Governmental Efficiency, that's what they're looking at trying to do. Cut government spending wherever they can. U.S. government debt and stocks. So how does the S&P 500 perform as a percentage of the debt to gross domestic product? Well, it typically goes up. All right. And generally, when the government spends more, there's more money out there. And so there are many companies in the S&P 500 that benefit from that. Typically, government contractors, defense, materials, manufacturing, that sort of thing. All right. Let's talk about inflation and interest rates. Inflation continues to subside. So there's a bunch of lines here, but what's important is if you look all the way to the right, you'll notice that inflation has come down to around the 2.5% level. The Fed wants it at around 2%. Okay. So it has moderated significantly from 2022. It comes up. In fact, the numbers today, the market's having a pretty good day because the consumer price index or the inflation numbers came in lower than expected. So that's a sign, an indication that maybe the Fed will lower interest rates. And the Fed lowering rates is completely tied right now to inflation. And so long as inflation continues to come down, so should interest rates. So if you look starting on the left-hand side, all right, you're looking from March 19th, 2025. That's one of the next open market committee meetings of the Fed where they decide what they're going to do with interest rates. And so we're expecting this year maybe 2 interest rate decreases of 0.25%. So about a 0.5% cut in interest rates this year. But as we go through the entirety of 2025, it's very possible that we could see even more interest rate cuts priced in. That doesn't mean we're going to see all these rate decreases this year, but the market will begin pricing in future rate decreases. That's what the market does. It prices in the expectation of future rate decreases well before they've ever happened. And if the market doesn't get what it wants, then it will give back some of the growth that is likely to result of this. But we are on a nice slow glide path. Now, you might think that the Fed lowering interest rates slowly might not be as advantageous as if they just drop them and drop the hammer, right? But that's not true. Historically, the performance of the S&P 500 is actually higher from the first rate cut when they have a slow rate cut cycle. The blue line represents slow rate cut cycles. And from the first cut, which happened in March of 2023, right? No, 2024. March of 2024 was the first rate decrease. And when you go out, notice how the S&P 500 goes up when they lower rates slowly, which is what they're doing right now, 1/4 of a point, 1/4 of a point, 1/4 of a point. That slow glide path creates stability. It creates a little bit more certainty and dependability. And when the market has dependability and certainty, it tends to want to go up more. So it's actually probably better that we're seeing a slower rate decrease cycle because the S&P 500 from that first rate decrease tends to perform far better than if we see faster rate decrease or no rate decrease at all, which I find interesting. I think that's pretty interesting. I am going to go a little bit longer here. Oh, well, no, I guess that's the end. That's the end. Don't even remember what I talked about. So anyway, I hope you enjoyed that. I enjoyed putting it together. I love digging into all this data. I'm not Nostradamus. I have absolutely no way of knowing if any of this will come true. But speaking as an advisor, someone who works with clients every day, I feel pretty optimistic about the future, at least the next year. Because all the indicators that we look at seem to be trending in a positive direction. Now, of course, if you're one of our clients here at Chapelwood, we're going to be paying attention to the year, what happens. There could be something that disrupts all of this. And if it does, we'll have the conversation. Do we need to de-risk? Do we not care about it? But more importantly, I'm always going to bring you back to the purpose for why you're invested. It's not to try to time the market. We're not trying to hit home runs. We're trying to hit singles and doubles consistently so that you don't run out of money in retirement. And if you keep the focus on income and funding your lifestyle as opposed to trying to beat or match the stock market, you're going to live a much happier life. And that's a lot easier to do than try to beat the stock market because it's really tough to do.